Okay, I think we're live.
Are we? Okay, the participants are, okay, cool. Welcome everyone. My name is John Sabo and I'm president of Dallas YPE. We're happy you all are joining us today. We know this has been a difficult time in Texas this past week. So again, we're grateful that everyone's here with us and joining us for what should be a pretty interesting conversation today around Pioneer's acquisition of Parsley Energy and the broader M&A market. But before we start with the conversation today, I'd like to introduce Dr. Tom Bates, an adjunct professor from the TCU Neely School of Business, and frankly, the professor that everyone wished they had had. So Dr. Bates, please.
Well, thank you, John. Look, energy is a very exciting topic today, whether we're talking about a Biden green energy agenda or whether we're talking about meeting the Paris Accord climate objectives, or whether we're talking about cold snaps in Texas. I think we need to have a balanced view on energy. We're going to need oil and gas for a long, long time, but wind and solar are going to be becoming increasingly more important. So I think we're at a point in the energy world that is really exciting. So it's always fun for me to talk about energy. And I will make a shameless plug for the Energy MBA program at TCU, which I have been affiliated with ever since it got started. I've hired about 50 CEOs during my career. And I always felt that having an MBA was kind of the single most important characteristic to get into that CEO position. And I think, if anyone is interested, we have a webinar on March 3rd, which will explain more about the TCU Energy MBA program. We've also recently incorporated the Energy Institute at TCU into the Neely Business School. So, we have access to research, we have access to policy. So I think it's going to be a really interesting time to be in energy. And if you get a chance to be in energy at TCU's Neely program, I think that's even better. And if you take my class, I promise I will teach you how to make $5 million in 5 years.
Wow, sign me up, Dr. Bates. Great, so let's get started with our conversation. Now, Dr. Bates and I will be speaking with Chris Paulson, Vice President of Business Development at Pioneer. Chris has been at Pioneer for almost 20 years, correct me if I'm wrong, Chris, and has been leading Pioneer's business development efforts for a decade almost. He's a pro when it comes to upstream M&A and taught me the basics when I was fresh out of SMU trying to figure out what a BOE was. So I'm thrilled to have Chris join us today. Chris, welcome, and thank you for being here.
I'm glad to participate. Thanks for the invite, John. Good talking with you.
Awesome. So let's get right into it, Chris. Pioneer has made a significant M&A transaction this past quarter, Parsley Energy, and this was a pretty big transaction. I mean, the biggest since the Evergreen acquisition back in 2004. So tell us a little bit about, why now? Why Parsley?
Yeah, so as you all know, last year the energy world changed and changed pretty quickly in March. We saw Pioneer stock price drop by a magnitude of 50% in a pretty short period of time. And we saw commodities obviously drop well below zero at a point in time. And so, Pioneer has always maintained a strong balance sheet. Ever since I've been at Pioneer, since 2002, our mantra has really been to maintain financial flexibility. And that really harkens way back to 97 and when Pioneer was formed. We were formed with a merger between Parker and Parsley and Mesa Petroleum. With that transaction, Mesa brought in a lot of debt, and associated with that, post 97, 98, 99, we had to do a lot in the way of deleveraging. And we actually were one of the few companies in history to kind of drill ourselves out of potential bankruptcy. And so there were some lessons learned, some priorities made to be investment grade, and with that to afford financial flexibility in times like what we experienced last year. And so while the equity valuation for our stock dropped pretty quickly. There was a nice recovery associated with that, and we fell by less than a lot of our peers. And I think a lot of that was related to the fact that our debt to EBITDA measures were intact, that we had a great inventory, that our long-term story was well intact. And so we started to, refresh some of our latest work on some of our peers, and Parsley was one of those. At any given time, Pioneer over the past couple of years has maintained an inventory of potential opportunities of the inventory set of all of our peers. Nimish Pandya has done a great job, along with Jace Parkhurst and others within the team, of laying sticks on every one of our peers' acreage positions, and having EURs tied across various intervals with various stage spacing, working interest, NRIs, et cetera. And at the end of the day, we kind of rank our relative inventory to everyone else. And, Parsley was one of those companies that we felt like was undervalued, that we thought that their inventory stacked up well to our own, that we could experience some operational synergies straight away, that we could experience some financial and G&A synergies straight away. And so all that came together at the same time that Parsley was being contacted by other players, and they were contacted by some other interested parties, and also reached out to us in that process, and we did the necessary work to say, hey, this is something that makes sense, and that can be accretive on free cash flow, accretive on cash flow, and also hit its marks in terms of NAV. For Pioneer, it's always been a challenge to have considerable inventory duration that matches with Pioneer's. And I would say Parsley was one of those companies that had a reasonable inventory duration that matched well with Pioneer's. There's a lot of peer companies that would not be the case. So at that point, we engaged, we did the necessary work. There was continuing dialogue, as you'll see, as you could read in the proxy, for some period of time. I think the boards over time got more comfortable with the transaction as well, and got more comfortable with the familial relationship of the transaction as well, based on some of the safeguards that we put in. So that's kind of it in a nutshell.
Awesome. Yeah. And so you mentioned Scott Sheffield, CEO of Pioneer, and Brian Sheffield, chairman of Parsley, were both excluded from the negotiations, correct?
That's right. You had to set up some processes by which those related parties were really excluded from the process. So in terms of the major deal negotiations, Matt Gallagher and his legal counsel, Colin, were involved in a good portion of negotiations, along with their lead chair, Ray Almedine, and who's now a board member of Pioneer. Both Matt and Ray are board members. And then on our side, Mark Berg and Rich Daly, our CFO and EVP, along with our head board member as well, were the folks who really led the negotiations. And both Scott Sheffield, who's our CEO, and Brian Sheffield, who was the chairman at the time, were left out of that process.
Great. And you had mentioned some of that, that methodical process to ascribing or evaluating offsetting positions, laying stick by stick on an adjacent or offset operator's position. And I can speak firsthand to that process. I've seen it up close and personal. But when it comes to Parsley's Delaware position, which is outside of Pioneer's legacy asset base, how all did you approach evaluating that position?
Yeah, so I would say we've delved into the Delaware on the technical side at various times over the past 10 years. We made a run some period of time for a large acquisition, about 8 years ago in the Delaware, and then kind of dusted off our work in 2015 and 16 and did a deep dive technically in the Delaware, and then maintained that work product ever since. And so over time, that work product is stretched further west and certainly further south as, Brigham continued to extended play and later became Diamondback as Silver Tip or Silverback, and others were involved in further south. And so we continue to refresh our work and continue to refresh our work as, as Parsley continued to develop their trees area and others. So we were familiar with that asset and familiar, I would say it's something far better than a 30,000 foot view. But when you do a M&A deal, you really delve into it deep. At the end of the day, both Jagged and Parsley before them had developed that acreage at relatively tighter spacing in the Wolfcamp Bay. We felt like we could extend that spacing a little bit, continued to see strong EURs and in fact some improvement on EURs. And like the upside associated with some other intervals, including the Wolfcamp B and the Bone Spring Shale. And so the Delaware is an area that we think should and will compete for capital, especially as we drive down D&C costs. At the time, their D&C costs were, let's say, around $900 a foot. Their, peer companies were starting to bring down costs pretty meaningfully from $1,500 a foot to $900 to $800. And we feel like, at least in that portion of Delaware, there's no reason why we can't continue to bring that down pretty meaningfully. And obviously, we've seen that from peers around them since the transaction. So we're exposing about 5% of the capital budget to Delaware next year. That's in part keeping with Parsley's plans. And so we just inherited their plans and we're continuing with that. I think in time, you're going to see a higher exposure to the Delaware, and we're excited about what it can yield with the high oil content and driving down D&C cost, and then some of these secondary intervals, or at least intervals that have been secondary today.
Hey, Chris, you guys had a press conference this morning where you announced earnings, and one of the things that came out was the idea of a variable dividend. That's certainly an innovative concept in our industry, and Pioneer has a history of being a model steward of shareholder capital. And I just wondered if you could talk to us a little bit about how that variable dividend works and what was the motivation behind instituting that concept now.
Sure. It's a concept that we began to socialize some time ago. And in the way of socializing, you elicit a lot of feedback from shareholders and prominent shareholders and others. And there's been some folks who have been outspoken about return of capital within our industry, and return of capital, not knowing where the industry is going to be 10 and 15 years from now. And that return mantra really started happening in a big way, growth to value, if you will, in a big way, probably 2 to 3 years ago. And I think most companies, including our own, really shifted from a growth at all cost type mentality, because we've had such a large inventory and we want to bring value forward, to returning cash to a free cash flow model. And a lot of companies are really challenged by that. They're challenged by that because where they were in their development life cycle, they were pretty immature in their development life cycle. And so you didn't have the requisite cash flow to really support a free cash flow stream. But Pioneer had a couple things going for us really in pushing towards free cash flow a lot sooner than many of our peers. And one was, again, a low interest level. A relatively low interest coverage that we had to contend with. And again, some mature assets and also some really strong, returning assets. So, break even level, as we noted today in the conference call, sub $30 a barrel now with some of our costs, and really driving down costs and the economies of scale. And so all that to say, we had socialized this variable concept. We had tried to be thoughtful about it in terms of how to differentiate it and how to get investors back on board with investing in the E&P space. And at the end of the day, what we're trying to do longer term is return about 75% of our free cash flow to our shareholders. This year, it will be about 50%. We project about $2 billion of free cash flow. Some of that will be in the form of a fixed dividend yield, and that equates to, let's say, around 2%. And then the other this year will be in the form of a variable dividend yield. I think what's interesting is we are staggering those dividends. So you'll get 8 different checks. It makes the shareholder a little more sticky, knowing that they're going to have these checks staggered throughout the year. And we also establish kind of that framework and so forth a little bit retrospectively. So at the end of the day, we really want to be able to return about target around a 10% total return to our shareholders between growth of around 5% or less in the case of this year, and then a fixed dividend yield and a variable dividend yield on top of that covers the remainder. So that investment thesis was discussed at length last year, and now the variable dividend was rolled out this year. And to date, there's really only 2 companies who really who've rolled out that variable dividend construct, us and Devon. And I think it's an interesting new construct for the industry.
Yeah, Chris, and continuing on with that theme of returning capital to shareholders, Pioneer has definitely been a front runner when it comes to that effort. And now, pro forma this Parsley deal, the Permian position has to be in total close to 1 million acres. So one has to imagine that there's plenty of AMD opportunity in the future. Can you speak to that at all? Sure.
Yeah, our acreage position is around 920,000 net acres at last glance, which is a massive position within the Midland and Delaware Basin. We think there's obviously a lot of value to scale. We're around a $35 billion enterprise today with several notches above investment grade, and so scale is important in the industry. As our CEO has said in the past, there's relevance to scale, and there used to be a scenario by which $1 billion was large enough scale, and then it was sub $5 billion was not interesting component to shareholders. And then the question is, what type of scale gets you on the radar screen? And what we've realized over time is that there have been fewer and fewer analysts on the buy side supporting the industry. And as S&P 500, as energy has been a smaller and smaller percentage, there's less desire and willingness to support some full-time energy analysts who are doing some stock picking. And that means that in general, in order to get energy exposure, a lot of portfolio managers are just picking 1 or 2 or 3 energy stocks. And they're oftentimes hitting the easy button and saying, hey, here are those that have scale. And so, scale, I think, is important in that regard, but obviously having a differentiated value story and value proposition is also important. So we're mindful of both. And so as it relates to M&A in the future, I think we need M&A. Any type of M&A in the future would, one, have to come with, as I mentioned, free cash flow accretion to our shareholders. It would have to be supportive of our variable dividend yield construct and accretive to that. It would have to bring inventory duration that is similar to Pioneer's, and therefore similar, make sure that we're not by any stretch diluting our NAV. And so that makes for a tough hill to climb. We do have a premium valuation. Oftentimes in M&A circles, if you have a premium currency, people really want you to push that premium currency in the form of M&A. but we're very selective. And so I think it would have to be a special deal. And I think, in general, it would have to bring with it meaningful, synergies for the combined Pioneer entity. So we continue to keep our models fresh. And, there are some folks, I'm sure at some point in time, that will come knocking, and we'll just have to decide whether or not it's worthwhile at that point in time.
Yeah, that's interesting, Chris. And because the Parsley acquisition sort of breaks with Pioneer's stance towards M&A over the past couple of years, which has been, we have a dearth of inventory, and that's what will capture most of our capital. Our capital will be concentrated on developing this inventory. So it seems as if now Pioneer is also changing that stance slightly, not just with the Parsley acquisition, but also in terms of future acquisitions. It could be more so categorized as active at the right price. Would you say that's fair?
I think you have to be very selective, maybe not active, selective, and have to decide that it is something that shareholders would be supportive of. And you always have to be careful of doing too many deals as it relates to that. So I think we're very selective, and you have to be receptive to folks who come knocking and listen to the story, but you also have to make sure it checks a lot of boxes. So I would want people to leave this conversation today by saying, hey, Pioneer kind of knows the field, and we have a take on the playing field, but we're not out there actively pursuing transactions at the moment.
That makes sense. And so, and then just given sorry, Dr. Bates, go ahead, jump in.
Well, I just want to stay on this M&A theme. It's clear that Pioneer has been very picky, and obviously any target has to meet, pretty rigorous internal requirements, and there have to be synergies. But does it surprise you that the overall environment hasn't seen more consolidation? Because I think if you would have asked the analysts midway through last year, the research community would have said, yeah, there's going to be massive consolidation. And yet we haven't seen that. Do you think we're going to see that in the balance of 2021?
Well, I think it was very challenged in that, especially through the middle part of 2020, where the landscape was shifting really quickly, and there was a lot of uncertainty and a lot of discord associated with our industry. I think it was very difficult for people to step out in faith and try to take on more leverage. And most of the deals that didn't get done were tied to folks with pretty high leverage numbers. So in general, had more than 2 times debt to EBITDA type of leverage numbers. And so the deals that did get done were companies that had terrific asset base, but also had a reasonable balance sheet. So the balance sheet was in order. And so I'd say that was kind of one of the key reasons why more did not get done, especially given that many were trading at a pretty severe discount. But they were trading at that discount because of concerns associated with bankruptcy and others. I think at some point in time, there needs to be more merger of equals. There were a few merger of equals, and generally those were well received. I think that, again, there's other benefits of scale as we face this energy transition environment, clean energy environment that you spoke of. It really pays dividends to have scale, to have teams dedicated towards improving your overall environmental footprint, but also improving your overall social and governance scores, working on things like task force on climate related disclosures and so forth. And oftentimes companies that are smaller in scale just don't have that ability to to attack these things that are attacking our industry and come up with good solutions towards that end. So I do think that you're going to have more merger of equals. I do think shareholders will require that. G&A per BOE is a big item in our industry, and it's an item that will continue to be important. And the only way in which to really get that down is to find, for a lot of small companies, find attractive acquisition opportunities at a kind of an MOE scale, and then drive down operational synergies. So yeah, I think it could and should happen. It just comes down to management getting together and somebody electing to step aside.
So can I follow up on that MOE comment? Because I think that's really interesting. But even in an MOE, you've got to refinance some debt, right? And access to capital has been very poor for the last many years. I mean, really since 2016, access to equity and debt capital has been harder to come by. And in 2021, it's essentially not there. Do you see that changing in the near future, access to either equity capital or debt capital?
I think one would speculate that the debt capital will continue to be very challenged, given the number of bankruptcies that have occurred, but also given the fact that there are more and more green bonds being issued and more pressure on banks in general that lend to our space. So there have been some here very recently that have just departed from our space, some European banks, but also even Canadian banks that you would not anticipate. So I do think debt will be potentially even more challenged for some of the smaller institutions. For Pioneer, we were able to refinance Parsley's debt at average coupon of around 2%, which was a pretty meaningful debt reduction amount and interest amount, I should say clearly. And so, with scale and with investment grade comes real opportunities to refinance some other debt. But I do think it's going to be challenging going forward. I talked about the equity headwinds of being relevant at a scale. And I know that everyone is challenged with that, including Pioneer, at staying relevant, improving our ESG benchmarking scores through MSCI, Sustainalytics, et cetera, making sure we give folks every reason to want to invest in us. And so, that's the challenges for the industry right now. And also as it relates to debt financing too, you need to make sure that you're in certain operating areas and in operating areas that not only have great returns, but also have reasonable environmental conscious about it. So we've also seen lending to the North Slope go by the wayside, and I think there are other areas that where people operate where we may see less willingness to support capital.
Yeah, Chris, Dr. Bates brings up a good point in that when we were hearing about this commentary about a broader M&A consolidation coming into the space these past 2 years that hasn't really yet materialized, within that commentary was also we should see a merger of equals or that type of transaction more often than we have in the past couple of decades. So do you think the fact that we haven't seen more MOE type transactions is because just we have competing ideals within management, or is it maybe some of those difficulties and those headwinds being faced in the capital markets?
I think it's all the above. I think if there was an easy button, people would have done it. I think there are a lot of folks contending with where they're going to get, how they're going to get their revolver and their credit facility progressed for the next year or several. Who that it was their primary focus for a period of time, and how they're going to refinance and turn over the bonds coming due in 2022, 2023, et cetera. So there's been some hyper focus on that. There's been some creative structures with some equity conversions, especially with with some subordinated debt where people just knew that it was in such a subordinated state it wouldn't get paid. We've seen a lot of bankruptcies come out with the banks owning the entirety of the equity and converting to equity. So I think it's, a big part of it, John, is just that I think first and foremost, players are trying to put balance sheets in order. They weren't necessarily seeing that doing a deal would change their course on the balance sheet. It actually may have just made it more complicated with more bond holders and so forth and so on. And so I think part of that is folks each were contending with their own problems, and they did not necessarily see the merger of equals improving that. They just saw it getting more complicated. And so once people do some more workouts on the debt side, I do think we'll see a few more MOUs. And I think we're seeing it forced. We're seeing more activism in our space. We're seeing some prominent activists who have really forced an investment thesis. And we're seeing other things like management compensation being tied more towards ESG metrics, more towards a relative comparison with people, with companies, not just within our industry, but with the S&P 500, but also the OSX, or more of an extended peer group. So those are all the things that are changing. And with that forced change, I think, senior management say, hey, we need to find a way to bring value to our shareholders, and maybe the merger of equals is the best way to do that once we get our balance sheet in order.
Yeah, that makes sense. And, you mentioned this earlier, it has been interesting to see some of these banks emerge from these proceedings and actually operate these assets. I think everyone's been a bit surprised by that as well. But Chris, I'm curious what your take is. What do you think comes first? Is it the capital markets opening up to some upstream M&A names, or upstream names rather, or is it the traditional investor that was active in this space a decade ago and has been on the sidelines ever since? Which comes first?
I'd have to really refer that back to Neil Shaw, our current CFO and in charge of IR. There's no doubt that we have seen a different class of shareholder in the last year or two. Again, the movement from growth to value. So we see a lot more in the way of value shareholders. And I think value shareholders in the last few weeks and months have really seen a pretty sizable increase in their portfolio, their energy portfolio holdings, and seen an improvement. And they went searching for value, and I think they got it. And so, we've seen some new shareholders. Whether or not that has been the case throughout the greater, independent universe, frankly, I just haven't kept up and haven't seen whether or not that's kept pace. I know there was high beta for a lot of small companies once we started seeing oil increase, and you'll always see that, right? As oil prices have increased, as demand has increased, as Saudi played their card in January, we saw high beta movements from some of our smaller cap peers. And the big question that I think you're asking is whether or not that will hold and remain, and whether or not folks will continue to be interested, or whether or not they were just plain beta, and whether or not you'll start seeing a movement and migration back into mid and large caps in a big way. Everyone's moved up, but certainly they moved up very quickly. And they should, when folks were concerned about a continuing going concern. And all of a sudden their EBITDA increases by X% because of these commodity movements. So it's a tough question to answer.
So Chris, you've mentioned ESG a number of times, and it's apparent that the ESG momentum is something that we all need to pay attention to, and measuring your performance in ESG terms is going to be very important from now on. If we take a look at kind of the European majors, BP, Equinor, Total, they moved into wind, and they moved into solar, and they moved into energy investments, but non-traditional energy by their pedigree. We've now seen companies like Chevron announcing a renewable gas, natural gas initiative, and we've seen ExxonMobil in their recent earnings announcement talk about carbon capture, utilization, and storage. Do you see anything in the large independent operators in the United States that would portend a movement toward solar or a movement toward wind for a company like Pioneer or your peer group?
Sure. Well, Europe has been a different animal than the U.S. for some period of time, and much more progressive in terms of clean energy policies and clean energy, framework on the government and policy side, and so those companies have had a lot more pressure on them than have their U.S. counterparts in Chevron, Exxon up until recent. And so those companies really have been feeling it for some period of time, and they're uniquely positioned in several of those companies' cases, like Shell and Total and others, where they have a retail framework. So they have a retail relationship with the end user, with the end customer, and they also have power and trading groups and other things that have, and of course, work world-class offshore projects and other things that will enable them to get into wind and do wind well and do offshore wind well, and continuing to feel like they want to have a relationship with the end user and be in the power business. BP had their light source deal, Total and Shell each have had their own deals, and so I think that has enabled them to make that move. The other thing is they had a little bit higher leverage, and interesting enough, many utilities and others who are in green energy have higher leverage metrics than do oil and gas companies, and so you need that when you're dealing with some lower returns. Lower returns, but yet lower risk in terms of continuing cash flows. When you have 12-year power purchase agreements or 20-year power purchase agreements, all that comes together to support a higher debt load from a corporate perspective. When we think about independence, and we think about what we do well, I heard from another peer company yesterday that that renewables and so forth, it's not an area that they want to compete. And I think Pioneer is, in that same boat. It's not an area that we intend to try to compete. We like the idea of adjacencies. So supporting clean energy as it relates to adjacencies within the Permian Basin. I think you'll see over time more of our power being supplied by some renewables. We do own a large surface footprint within the Permian Basin and own several sizable ranches where we own the minerals and surface, or have a meaningful mineral position in surface. And so I think those are ideally situated for potentially wind and solar to support our own field operations behind the meter, if you will. So we've spent some time on that. We're very familiar with the economics, and I think we'd be willing to support some power purchase agreements over time that help provide us renewable energy credits, help offset our scope 2 emissions. So I think we would consider that. In terms of other clean energy, we are dangerous in terms of our knowledge and our relationships on, various areas: hydrogen, carbon sequestration, rare earth minerals, et cetera, but we still need to do a lot more work there. And I think the way in which to do more work there is partnering with somebody who's been there before. And at some point, we very well may partner and expose some limited amount of capital, but it would be I would say a pretty minimal exposure for some period of time. And ultimately, we need to, whatever capital we expose, we'd have to convince our shareholders that that makes sense over a variable dividend. And so that's what we need to work out and work through. But we certainly continue to think through how we improve our methane intensity, our greenhouse gas intensity, and scope 1 and scope 2 emissions, and at what point does a net zero target make sense for an independent. And we've seen a couple independents talk about that recently. We want to make sure that if we ever put out a target like that, that it's not way out into the future without legs to it, that we've kind of initiate a framework similar to our variable dividend framework that we could actually execute on in the next 10 years. The one other thing in that regard, we do some scenario planning. We do think about the next 10 years. We do think about the world, what the world could look like according to actions from OPEC Plus or progression of clean energy, and that progressing at a faster pace than, let's say, hydrogen progressing at a faster pace than one would think, or EVs progressing at a faster pace, or et cetera, et cetera. And we try to think through all of that with an ESG mindset and how that affects our industry. And that's a real challenge within our group, and something that we've stood up over the past few years, and it's continuing to evolve, frankly, by the day, and improve by the day. And it's a big task, and we work closely with our environmental group and our operations group and others to make improvements at the margin, to electrify more. Pioneer's got one of the biggest electric grids out there, our own grid, and we do electrify a lot of our operations, but maybe potentially how we can do more of that.
Yeah, Chris, I'm sure the BD team is up for that challenge. But I wanted to leave a few minutes here for Q&A, and I encourage everyone to utilize this Q&A function if you do have a question, and I'll do my best to get to it. But Chris, we do have a few questions coming in. One common theme here is, given that 920,000 acres in the Permian, on a smaller scale, on an asset scale, the theme for Permian, or for Pioneer before this transaction, was a lot of blocking up acreage trades. Do you see that continuing on? Do you see potential for divestitures? What does that look like?
Yeah, it's we are active on the trading side. We're always open for business on the trade front, and Brandon Licata does a great job managing that process, and he's kind of your point person on that front with Pioneer. In terms of divesting of assets, we've done some selective divestitures. We did $6 billion plus of divestitures for the past 8 years, but here recently did some selective divestitures in certain areas where we had some scattered acreage extent. And we'll continue to think about that even as it relates to Parsley's acreage that just doesn't fit perfectly within the kind of Pioneer core areas. I think what we always need to be mindful of is what is our use of proceeds, and where do we put it, and some of that can be used to pay down debt, but we also need to be mindful of what does our inventory look like 7 years from now, when some of the areas that, or 5 years from now, when some of the areas that we would otherwise consider selling, we could have bulked up or traded around and moved into. So that's a constant challenge in thinking through that. But I would suspect this year that we may make some divestitures at the margin, but I wouldn't see anything really meaningful.
Got it. Well, that is just about all the time we have today. So I wanted to thank TCU, Dr. Bates, and especially Chris. Thanks for joining. This was an awesome conversation. Appreciate your time. Best of luck. And I want to remind everybody that there's still some spots available for the YPE golf tournament. So feel free to register. We'd love to see you out there. And thank you again for joining, Chris, Dr. Bates, Meredith, everybody. Thank you. And we look forward to seeing you guys at a future event.
You bet. Glad to participate. Good seeing you, John. Thanks, Dr. Bates.
Great seeing you, Chris.